So, investing in real estate can be extremely lucrative and a great venture to get into, regardless of your age, ethnicity, race, gender. But here is the most important strategy that is going to minimize your risk and maximize your profits. And today we are talking about the 70% rule. So come on in and listen up. As many of you guys know, I am a huge fan of investing. Not only investing in a bunch of different like real estate, but other types of investments, because there's nothing like putting your money to work for you. It's almost like having an employee out there generating that additional income for you. So today we're going to focus solely on real estate and some of the things that you really need to look at, and what the 70% rule and how I have personally used the 70% rule to build an empire of properties and to have a net worth that is way more than I am worthy of. So stay tuned. What is the 70% rule? The 70% rule is we are going to look at the ARV of the property, okay? That's the after repair value of the property. That is, if you were to buy a property for, let's say, $100,000, and after everything's complete with the renovations on the property, it's worth $200,000, well, that is the price of the property after everything's renovated. So what we're gonna do is we're gonna take the after repair value, and the 70% rule is we take that after repair value and we multiply it by 0.70, which is 70% of that after repair value. And this will kind of give you the maximum amount that you should pay for a property. And that should include all the renovation costs. So why is that important? That means you have 30% to kind of give you a cushion to fall back on just in case the market tanks. So if it tanks, let's say 20%, you still have 10% equity in the house and you could sell it and get out of it without any loss. Okay. Yes, you would have lost the time. You would have lost the headaches that went along with the renovations. However, once everything gets going and the more that you have, the better everything is. By sticking to the 70% rule, you can kind of avoid paying extra or overpaying for properties. And that's probably one of the biggest challenges that investors face when looking to get into the market. I used to have a rule where, hey, if I were to buy a house and I'm going to flip it, I have to make $30,000 on the property, because I have to take into consideration what is the tax rate, what are some of the other factors. And when I found out about the 70% rule, this is something that I've used over and over again. And with this formula, it can kind of help me overcome any unforeseen expenses and get my desirable profit margin on everything. With that in mind, here are some of the most important things to really consider when you're out there looking for an investment property. The first thing is location. We've all heard realtors, we've all heard talking heads on TV talk about this. Location, location, location. Not only is location important, just think about it like this. If you're gonna buy a house for your family to live in, what is important to you, right? You're looking at different things, and location has a big factor in it. So we're going to use me for an example. I've got 3 kids. They're all young age kids. And I want to put them in a great school system. I want to put them in a neighborhood with a bunch of like-minded, families and kids. I want to make sure I put them in something that kind of leads me into the next thing that you should be looking at. I want to buy a property in an area that has really good market conditions. So for instance, I am in Norfolk, Virginia, and I live in a suburb of this part of Virginia. And this area has the top rated school systems. The proximity to the interstate is very close. The proximity to the big cities such as Virginia Beach, Norfolk, and the other 7 cities. I'm right in the middle, so everything's easy to get to. And if I were to not want to live in this property anymore, guess what? The potential rental income is there too. If I look at my mortgage and I compared it to what the rents are, I will probably be making about 30 or 40% if I were to put my house on the rental market today. The second tip that I have for you, whenever you're using the 70% rule, is network with experienced investors. I can't preach this enough. You can always go do it yourself. You can always read things on the internet, and you can watch these YouTube videos. However, the way that I've gained most of my knowledge is in mastermind groups, talking to other people that are like-minded, talking to other people that are willing to share and be willing to share with other people as well. And that's really made a huge difference. So, going and joining your local networking group with other real estate investors or REIT investors, whatever it is, just learn as much as you can, soak it in like a sponge. Don't talk too much, listen more. And, always thank people for their expertise that they're giving you. Third tip would be following market trends. Okay. Market trends are really, really huge. For many years, flips were the trend, and then long-term rentals were the trend, and then multifamily units were the trend, apartment buildings, storage units, and short-term rentals. Whatever the trend is, you have to know the trend. Be at the forefront of the trend. Don't be in the back end of the trend, because when the market gets oversaturated with that trend, guess what? If you're not the top of the market or the bottom of the market, the middle of the market is always the people that get flushed out the most. So always follow the market trend, conduct thorough research to gain a deeper understanding of your local real estate market. This knowledge will help you make a very good informed decision and increase your chances of success. If I were to take any notes of what I just said, that is probably the most important factor when it comes for me making my decisions on buying these. The fourth tip is paper trade. Anyone that's ever been in the stock market knows what paper trading is. And that's saying, hey, I really want to get into the stock market. And I talk to my kid about this all the time, my kids actually. I've got 3 young kids. They've taken up an interest in starting their own business. So in our neighborhood, we have golf courses, and they go to the lakes with their ball retrievers and they pick up balls. And during the summertime, they'll sell golf balls at the golf course. They'll clean people's clubs. They'll bring snacks out there. And, towards the end of where we live, on hole 16, if the golf cart person's not out there, selling snacks and things like that, then they really may have run out of snacks or water. So my kids are capitalizing on that ability to not only sell them balls, because by the 16th hole, they may have lost all their balls. Their clubs may be extremely dirty. They need water and they need snacks. So that's using their brain and making sure that they understand the trends of everything, and they've paper traded it, and they've taken that interest in the stock market. So before I let them enter the stock market with their earnings from selling golf balls and doing all the things on the golf course, I said, look, you want to get into the stock market? I want you to write 5 essential things that you cannot live without, right? And they would write down things like, hey, I can't go to school without my book bag. I want to have some nice shoes. We really love Disney World. We really love this. We really love that. And at that point, I will make sure I write down the stock symbols for those things that they personally have. And I say, hey, why don't we look at the trends of where this is, right? Right now we have this thing called inflationary pressure, right? So with that inflationary pressure, we have to see where the consumer spending's going. So let's paper trade this. Let's look and see if Disney is one of those things that, you can't just look at Disney World. You got to look at all the parent companies and the sister companies of everything, like so ESPN, all this other stuff that comes into play. What are they doing to increase profit margins and things like that? So when you're looking at properties, I would paper trade. Look at the properties, see what you're looking for, see what the houses were listed for, wait 30, 45 days, see what they actually went under contract for, and this is going to help you make a very informed decision. The 5th tip is really, really essential, and that is build cash reserves. Okay, build it as fast as you can. And this is going to accomplish 2 things. Number 1, it's going to tell you whether you can afford using that extra discretionary income. If there's anything that happens, recently I had an investment property that needed a roof change, okay? The roof had to be torn off and re-roofed, and that cost me $9,000. I had to make sure that, hey, do I have enough cash to handle this roof change? And if I don't have enough cash, do I have enough credit to handle it? Okay, so having that cash is really essential for that part of it. However, the second part of it is how much you put down is going to determine what the interest rate is. How much cash you have and versus like your credit card debt and the utilization is going to dictate what credit score you have when you're going out and getting financing. So at that point, we really want to build up that cash, and that way you can have that cash to pay down debts if you need to just maybe push that credit score from maybe 700 to 740 by paying down some credit cards. That would save you a bunch of money on the interest rate. You can also look at 20% down versus 25% down. That could save you money on the interest rate as well. So having those cash reserves and having them around is also going to open up your qualification to more investors. And as some of you guys have heard me talk about, I am with Nexa Mortgage, which is the world's largest wholesale mortgage broker. And with that being said, we have a lot of different options that we can shop with, right? So not only are we saving you money on the pricing, the product, and or the speed, this will also give you the option to kind of go out there and shop and maybe buy a unique property that's going to give you higher cash flow. Next thing that you want to do is you have to consider what your offer price is. And this goes back to knowing the market trends, knowing your area, doing this thorough research. And what I mean by this is if you're going to offer something to figure out what the ARV is, you cannot bid against yourself. And that's something that I am very, very disciplined in, is when I set a number, and let's just say I'm bidding $150,000 on a property, I will not go to $150,000 on $1, because to me, that type of lack of discipline is going to make you jump into something that you should not jump into. So if there's that feeling, or if you're getting pressured from, the listing agent or the buyer's agent to, hey, you need to bid higher in order to win this, use your market research to help you come up with the most informed decision to do this. Rental income. Rental income is huge, right? If you have to exit the property, I've already alluded to this. If you needed to exit the property, or you didn't like the property anymore, or something happened, or you had to relocate, you have to be able to get that rental income to at least cover the mortgage payment. So people that are buying houses right now, the reason it's still a good market is, yes, it's less competition. The properties that are coming up, we're seeing more and more price reductions. So the market's getting stronger for the buyer side of things. Okay, we're not back to where when interest rates were 3-4%, when everyone was just jumping in head first, overbidding, not asking for any closing costs, because we have to really weigh it out, right? On one hand, like this left hand right here, you're buying a house at a higher interest rate. However, there's a way out of this. There's the sale, there's the rental income, or when the rates go down, you can refinance. Whereas these people that bought it at a way lower interest rate are now possibly upside down. So if they wanted to get out of it, they may have to sell it on a short sale. Yes, they have an outstanding interest rate and whatnot, but that interest rate isn't going to make you any money. So when you're looking at this, you really have to consider that aspect, which is the rental income. The condition of the property is always really important. I always look at the condition of the property, right? I love going into houses that have holes in the ceiling, has black spots, which some people call mold, and you can't really tell if it's mold until you do a mold air test. But I want bad roofs, I want all this stuff, because it's called sweat equity. The more you put into it yourself, the more you're going to gain out of it, because you're not paying that labor side of things. The more work you have, the more ability you have to go out and find contractors that are willing to do it for your price, not their price. And that's really essential. And then finally, I would say delayed financing. Delayed financing is a great tool to use to buy houses. And what that is if you have a large sum of money, you can go in and buy the property with cash, and then within 6 months, you can refinance and get that cash out based on what you have purchased the house for. So let's just say we're buying a house for $200,000 and you're bidding against other investors, okay? What advantage do you have over the other investors? You could bid more, or you can say, hey, I'm gonna pay cash for this property. So you're not gonna have to worry about appraisals. You're not gonna have to worry about financing falling through. You're not gonna have to worry about title, none of that, okay? I'm gonna pay cash for this. I just want title work done, and as long as that's clear, I'm fine, okay? That shows that you're a strong borrower, and what delayed financing is going to help you with and give you an advantage on is when you go through that delayed financing, you could pay $200,000 cash for the property, and let's just say you're going to take a loan out with me anyways, and if you were to take that loan out and you wanted to put 20% down, then that's $160,000 that you're borrowing. with $40,000 down. So you could run this simultaneously of when you go under contract, the loan, you're still going to pay cash for the property, and the seller doesn't have to know. You may want to say, hey, I want to get an appraisal for information purposes only, or whatever it may be. What you're going to do is when you close on that transaction, if the loan's approved, great. You just say, hey, I want to switch this. My loan's already approved. You go through with it. However, if you're closing really fast and that loan's not approved yet, you could still pay cash for it. And during the process, because we're doing delayed financing, we're able to give you that $160,000 back into your pocket. Okay, so the advantage is you can go in with a cash offer, and we all know when you're selling a property, you want to get the most and you want to get it as fast as possible. So that's a huge win with delayed financing. But with all that being said, the biggest tip, and that's tip number 10, it is the essential 70% rule. The 70% rule is very important to not only my success, but a lot of investors that I've known and associated with and networked with. So if you have any other questions on the 70% rule or anything else that we've covered on this topic, or would like to get some financing, I'd love to help you out. My name is David Zai, and I'm with the Zai Mortgage Team. Feel free to reach out to me, 757-478-8493, and I'll talk to you later. Bye.